and welcome to this week's Property Insider video. As Dr. Andrew Wilson explains the latest property data this week, you're going to find that despite more properties coming on the market for sale, there are more buyers purchasing properties than new listings coming on, so total listings are falling. Plus, there's a number of other good bits of news that are very positive for our property markets moving forward. We're also going to discuss the Reserve Bank's views on stimulating the jobs, the economy and our property markets, as well as the latest employment data, and Andrew's got some interesting insights into that. So if you'd like to keep up to date with what's happening in our property markets, please subscribe to our YouTube channel and click the little bell icon so YouTube can keep you informed as our weekly videos come out. Some people are calling this the weirdest recession. We're in the middle of a pandemic, unemployment's rising, and yet our housing markets are remaining resilient. In fact, there are increasing signs the modest coronavirus-induced correction is coming to an end and the housing markets are on the move again. Now, last week I mentioned a palpable change in market sentiment. I noticed that on the ground and it's being reflected in strong buyer activity and at the time when there's little good stock on the market. But more recently, consumer sentiment and business sentiment has been buoyed by the job creating budget and by the promise of loosening lending criteria next year. And then more recently, the Reserve Bank signalled they were looking to even lower the cash rate further and reduce the 3-year bond rate. Now, while the bank signalled for another cash rate of 0.1% on Melbourne Cup may not do a lot in adding extra stimulus, locking in lower interest rates for a long time could actually reignite the loan market and house prices, especially if the RBA reduces the rate that it's charging banks on their exchange settlement accounts. Anyway, it looks like we're having a perfect storm. It's developing that our property markets next year are going to start to ignite, especially when you consider the federal, state and government incentives and the proposed spending the governments are going to do. So I'm really looking forward to my chat with Andrew Wilson today, Australia's leading housing economist and chief economist of My Housing Market, as he discusses the property data and the labour figures. Hello, Andrew.
Yes, hello, Michael. How are you? A very interesting introduction as usual.
An interesting week as always. And as I mentioned, a lot has happened, especially in the last couple of weeks. And I think it's all going to impact positively on our property markets. But before we discuss those various elements, let's start off with the latest housing market data, please.
Yes, let's have a look at the week that was, Michael. Let's start off as usual with the weekend auction market report. Another very strong weekend for auction activity. Sydney, again, the leader of the pack in terms of the number of auctions listed, and another strong clearance rate in Sydney, now pushing up towards 80%. Will we get an 80% clearance rate this spring? Certainly the trends are telling us we will. Auction numbers just up a little bit the same period last year. Of course, as we've discussed, those auction numbers now include online auctions, which previously would have likely been a year ago private treaties, private sales. So Melbourne doubled its number of auctions last weekend, and certainly we'll expect to see a lot more auctions in Melbourne now that the physical restrictions have been eased. A clearance rate of 63% off low numbers reported. So we still need to treat that with a grain of salt, but still a good result for those numbers of auctions that were reported. Other capital city markets doing quite well. And we can see there Brisbane above 50%, which is actually quite a good result for Brisbane, even though numbers were down. Typically, Brisbane struggles to get over 50% clearance rate. Adelaide and Canberra, more strong results there, particularly Canberra. That Canberra market really is up and running at the moment. And no surprise we've seen consistent price growth this year, where other capital cities have seen easing price growth. So that Canberra market's still one to watch, but no doubt that the energy is rising in our auction markets, and even Melbourne now is starting to take off to some degree. We can see the trend there for the Sydney auction market, trend now clearly upwards, pushing towards that 80% result, still below where it was a year ago, but not too far below at the moment, Michael. Best performer on the weekend in Sydney was the Northern Beaches, nearly 90% clearance rate, and the Central Coast also with a near 90% clearance rate. I think the interesting thing with those regional results was that we had 5 regions with clearance rates above 80%. Top price was a property in Avoca Beach of 4.2 million, of course, on the Central Coast in Sydney. Again, quite a reasonable spread of higher priced properties selling under the hammer. Melbourne, as I said, clearance rates, we're now starting to measure clearance rates with auction volumes now more than the handful we had a month ago. More of a solid underlying clearance rate will be revealed as we get higher listing numbers going forward. Now, talking about listing numbers, Michael, something a little different this week. We can see the trend moving upwards clearly over the past 3 weekends in auction numbers of Melbourne, which were virtually non-existent. But tracking forward with some forecasting, we can see a big surge in auction listings in Melbourne predicted over the next 2 to 3 weekends. So we'll see how that pans out, but certainly a big lift there. And anecdotal evidence agents are telling me they're also seeing a surge in listings coming through. But these numbers can tend to be volatile, but certainly that's starting to look a lot like last year's spring market in terms of listings, Michael. Top seller was a property in Ferris Place, South Melbourne, that sold for just over $2 million. New listings, we're starting to see certainly a surge in new listings coming through now. Of course, a lot of that is the Melbourne revival over the last couple of weekends, and that's building ahead of steam now. We now have new listings at a higher point, at its highest point of the year now. So certainly we've recovered from that coronavirus easing, and market seller sentiment is holding on quite nicely. And of course, fertilised by all those new sellers coming into the market from Melbourne. And if we look at the same time last year, Michael, we can see now that we are tracking at around about the same volumes in terms of listings as we were at the same time last year. So that's quite an interesting statistic as well. Melbourne new listings data over the week. We remember looking back to last week, Melbourne, Michael, we had a falling away of new listings advertised. That was reflecting the school holiday period, some seasonality there, but they've bounced back in most of the capital city markets after the end of the school holiday period. Melbourne down over the week before, but when we look at the relative position for Melbourne, when we compare all our capital city markets for new listings, when we compare those with Sydney as a base of 100 in terms of volumes, Melbourne has eased slightly against Sydney, but still the number of new listings last week, Michael, was 5% higher in Melbourne than it was in Sydney. So Melbourne's still very consistent in terms of those surging listings that we've seen. So sellers are back into the market now in Melbourne, Michael. The total listings, now this is the total number of properties for sale as of October the 18th, Michael, and that's compared to the same day the previous week. And we can see the total listings fell downward. And I think what we're seeing, that downward energy from total listings, given that we've got a lot of new listings coming through, is because we're getting higher numbers of sales now, Michael. I think what we're seeing now is that sales energy is tapping its way into listings, and that means there's more competition for buyers out there with fewer properties now being listed, overall listed. So that's interesting, sort of evolving into more of a seller's market now with competition amongst buyers. The relativity index is quite interesting as well. When we look at total listings now, total listings in Melbourne are now just 4% lower than in Sydney. Now this is total listings, total properties for sale. So that's reflecting that big surge we've had over the last fortnight in Melbourne's new listings, and total listings are heading towards where the Sydney numbers are. So let's have a look at sales. Very interesting results, as I was discussing before, Michael. Big surge in sales in Sydney. These are newly reported sales over the past week on a week-to-week change basis. Big rise in the Sydney number. They're now not too far away from their pre-coronavirus peak with new sales. Of course, we did have that little blip downwards for that seasonality, the same we saw with listings last week. If we look at Melbourne, now we're seeing some real energy back into the Melbourne market. A big increase in Melbourne newly reported sales last week, Michael. That's been consistently rising over the past 3 weeks. A long way to go. We're at a very low point still compared to where we were at the beginning of the year pre-coronavirus, but nonetheless a very strong upswing. We would certainly expect that to continue. And we always see buyers, Michael, lagging sellers in the marketplace when we are in this revival mode, but the trend is clearly upwards. And the Brisbane market particularly strong, Michael, as we've seen for most of the year. Again, it's bounced back after that pause period 2 weeks ago, and it's a very strong second half of the year market in Brisbane at the moment, Michael, as we typically do see a second half year winter summer type market activity in Brisbane. New sales up by 62.5% in Melbourne, as we said, coming off a lower base, but up across the board in all the other capital city markets. So sales are certainly still on the rise, but a real surge in Melbourne, but mentioning, of course, from a low base. And the relativity index gives us the proportion of new sales compared to Sydney as a base of 100. Melbourne's still nearly 50% fewer new sales last week than Sydney, but we can see the trend is clearly on the rise, and we expect that to rise over coming weeks as that pent-up demand, that coronavirus shutdown pent-up demand is released. And if we can look at Melbourne over the past week, new listings down just marginally over the week by 0.7%, but still maintaining a very strong level as we saw. New sales up 62.5% from a low base, but still rising strongly. Total listings down 1.2%, but now just 4.5% Melbourne's total listings below Sydney's total listings. So certainly lots of positive energy, recovery energy there about the Melbourne housing market. Just quickly with the economy, we've seen the All Ords picking up ahead of steam over the last week, Michael, perhaps a tick for the budget continuing on. Lots of confidence is around, as you did discuss last week, and that's working its way into investors with the All Ords now at a level we hadn't seen since back in March. The Aussie dollar, no surprise, is falling away. That's speculation on an interest rate cut next week, which is very strong. It was strong last month. It didn't happen. It did push the dollar down. When it didn't happen, the dollar did recover. But now it's certainly almost, dare we say, a certainty that rates will be cut, albeit marginally, on Melbourne Cup Day for that November result. Now, we have the big data out last week, Michael, was the labour market data for September. We saw the unemployment rate just squeeze up marginally to 6.9% from 6.8%. We can see that rebound over since the shutdown in the number of jobs found. Jobs actually fell in September, but there's a reason for that, which we'll look at in a minute. So jobs were down after having strong growth over the previous 3 months. And the return to the workforce also wasn't as strong as we've seen, although it was positive. But nonetheless, we've seen a big change in terms of the number of jobs being created and also the number of those moving back into the workforce since the shutdown over autumn. If we look at the unemployment rates on a state-by-state basis, Michael, we can see higher unemployment rates in New South Wales, question, and also in Queensland, question mark, and lower unemployment rates in Victoria. Well, how do we figure that out? That's sort of not intuitive, but we can explain that quite simply. It's actually a really good news result, Michael, when we look at the underlying issues. And we can see there that, again, Queensland and New South Wales, very strong jobs growth over September. But unfortunately, the issue has been Victoria, no surprise, savage loss of jobs over September, jobs down, lost over 30,000 jobs lost. And of course, when we look at the participation rate, and this is the workforce change, this is the reason why we've seen changes in the unemployment rate. A remarkable return to workforce in both Queensland and New South Wales. Nearly 50,000 returned to the workforce in New South Wales, Michael, and over 30,000 in Queensland. These are very encouraging figures, show that people are becoming more confident about finding work. That's why the unemployment rates went up in Queensland and New South Wales, Michael, because the workforce just really expanded so much and they couldn't offset the growth in jobs. You know, when we look at that, it's actually a positive result, believe it or not. But of course, the Victorian numbers, savage loss also in terms of the number of people that have actually given up looking for work, left the workforce. Nearly 60,000 Victorians left the workforce in September, Michael. And of course, that's why the Victorian unemployment rate actually fell. But in reality, it fell because the workforce just shrunk by that remarkable number. But hopefully, as the economy starts to regenerate in Victoria, those numbers will start to reverse. But I do think, Michael, this will be a longer journey in Victoria in terms of its reversal from workforce numbers and also jobs created, because there still is quite savage restrictions in industry. So that's it for this week, Michael. Some good positive news by and large, certainly housing markets up and running. And all economies, with the exception of the Victorian economy, are doing quite nicely. Still a long way to go, let's not kid ourselves, but we're almost becoming a poster child globally for advanced economies in terms of recovery post-coronavirus.
Well, that was great insights, Andrew, because you've got to dig deeper into the figures to really understand what's going on. And as you say, there is increased consumer confidence in the property market, but in general, this week, ANZ's weekly Roy Morgan Consumer Confidence Index rose to a 20-week high. It's up 50% since its record low in March. And That's showing in consumer spending and it's showing in our property markets. But there was even more good news. The Reserve Bank affirmed its commitment to supporting jobs, Andrew, to increasing people's income, to helping businesses in Australia with a couple of announcements. What are your thoughts on those?
Well, there's not much the Reserve Bank can do now, Michael, because of the very low level of interest rates that we have. Let's remember that back in previous economic downturns during the GFC, we had mortgage rates at 10% prior to the GFC. So there was plenty of room there to cut. And of course, we don't have to remind everybody that during the last recession, the bank bills were up nearly 20%. And, so there was lots of room there to stimulate the economy. And that's the nature of the cycle. This, of course, is certainly nothing to do with the cycle, and our cycle's changed considerably in terms of where interest rates are. So, but the point is, Michael, any move down will be a positive. It will put money in mortgage holders' pockets, and of course, it'll make property more affordable and it will increase confidence again. But I do think, Michael, monetary policy really is quite benign now compared to other periods, and that's just the nature of the change of the cycle. And when we stopped cutting interest rates back in 2015-16, that was probably the time when we should have cut. And when we started cutting last year and nothing happened, that was except the revival in the market, which shouldn't have been needed to be revived, the housing market then. But maybe if we had have held our fire then, we might have had a bit more to throw at the problem at the moment. But we're still in a comfortable position compared to others in terms of our relative interest rates. But I think, Michael, that the real deal now, of course, remains fiscal policy. And we've seen that from the federal government, lots of ticks for that from consumers and also from business and investors. But now it's over to the state governments to do their bit in terms of spending. And I will watch with great interest to see what they come up with through their state budget.
That's going to help jobs creation, business confidence, and then eventually consumer confidence. But more recently, the banks seem more eager to get business as well. And so they're out chasing new business. I think they're feeling comfortable also because the default rate on loans in general is low. So that fiscal cliff people were worried about hasn't occurred. A couple of years ago, the cliff was related to interest-only loans changing to principal and interest. That didn't happen. This year round, it was the September cliff. That didn't happen. And in fact, those loans that have been put on hold, more and more of them are being paid off. So our banking industry is in a good situation at the moment, isn't it?
Well, it is, Michael. And I thought it was interesting that the government basically had to come out and tell them to lend, which is... I can understand prudential lending and risk management and all those sort of issues, but we all know that they went overboard on that. We were hit around the head with the Royal Commission into the banking industry, which was really a non-event. And all it did was sort of scare the markets to some degree and make bankers even warier in terms of their lending. But the troglodytes haven't had a good year this year again. They've all been wrong. They're wrong about the cliff. They're wrong about house price crashes. They're wrong about depression level unemployment. Some people just are naturally wrong all the time, Michael.
It keeps the media busy. It keeps the journalists happy reading all these press releases. But fortunately, there's lots of green shoots. Sure, there's headwinds ahead, and there's still going to be some businesses that tragically are not going to be able to continue on. Some people are still going to have some health issues. But overall, our property markets are looking very positive. So I look forward to our chat again next week, Andrew.
Thank you very much, Michael.